The stock market is often seen as one of the most powerful engines for building long-term wealth. Over time, markets tend to grow as businesses expand, economies develop, and innovation drives productivity. However, this growth is not always smooth. Periodically, financial markets experience sharp declines known as stock market crashes. These events can wipe out trillions of dollars in market value within days or weeks, creating widespread fear and uncertainty among investors. For many people, a market crash represents financial disaster. Yet for others, particularly experienced investors, it can represent one of the greatest opportunities to build wealth. Understanding whether a stock market crash is primarily a risk or an opportunity requires a deeper understanding of how markets function, why crashes occur, and how disciplined investors respond during times of extreme volatility. Today, we will talk about stock market crash, risk or opportunity. So before we start, make sure to hit the like button and subscribe to my channel. A stock market crash generally refers to a sudden and significant decline in stock prices across a large portion of the market. While smaller declines occur frequently, a crash is usually characterized by rapid losses of 10%, 20%, or even more within a short period of time. These dramatic drops often trigger panic selling as investors rush to exit the market in order to avoid further losses. News headlines become dominated by negative economic predictions, and the general public begins to question the stability of financial markets. During such moments, emotions often override rational decision-making, which can intensify the market decline. One of the most common causes of stock market crashes is economic uncertainty. When investors believe that economic growth may slow or that corporate profits may decline, they begin selling stocks to reduce risk. Economic indicators such as rising unemployment, declining consumer spending, increasing interest rates, or geopolitical instability can all contribute to negative investor sentiment. When enough investors act on these concerns simultaneously, the collective selling pressure can cause a rapid market downturn. One common strategy used during market downturns is known as dollar-cost averaging. This approach involves investing a fixed amount of money at regular intervals regardless of market conditions. When prices fall during a crash, investors purchasing through dollar-cost averaging automatically acquire more shares at lower prices. Over time, as markets recover, these lower purchase prices can significantly improve long-term investment returns. Diversification also plays a critical role in managing risk during market crashes. A diversified investment portfolio spreads investments across different industries, asset classes, and geographic regions. This reduces the impact of a decline in any single sector or investment. While diversification cannot eliminate losses during a broad market crash, it can reduce volatility and provide greater stability during turbulent periods. Cash reserves can also provide strategic advantages during market downturns. Investors who maintain some liquidity are able to deploy capital when attractive opportunities arise. During market crashes, assets often become available at prices that would be difficult to find during strong economic periods. Investors who have available cash can take advantage of these opportunities rather than being forced to sell assets to cover expenses. Another important perspective when evaluating market crashes is time horizon. Short-term traders and speculators often experience the greatest stress during market volatility because they rely on precise timing and quick price movements. Long-term investors, however, typically focus on multi-year or multi-decade timeframes. From this perspective, temporary market declines become less significant when viewed within the broader context of long-term market growth. Historical examples illustrate how market crashes can ultimately become opportunities. During major downturns in financial history, markets eventually recovered and continued growing. Investors who maintained discipline and avoided panic selling were often rewarded when economic conditions improved. These historical lessons highlight the importance of patience and long-term thinking when navigating volatile markets. Education and preparation are essential for investors who want to turn market crashes into opportunities rather than financial disasters. Understanding economic cycles, market valuation principles, and risk management strategies can help investors make rational decisions during periods of uncertainty. Investors who rely on knowledge and strategy are less likely to be driven by fear during market declines. Another critical element of successful investing during crashes is emotional control. Markets are heavily influenced by investor psychology, and emotional reactions often lead to poor financial decisions. Investors who maintain discipline, avoid impulsive actions, and focus on long-term goals are often better positioned to benefit from market recoveries. It is also important to recognize that not every stock becomes a good investment simply because its price has fallen. Some companies experience declining prices because their business models are fundamentally weak or because they face serious long-term challenges. Successful investors carefully analyze whether a declining stock represents a temporary market reaction or a genuine deterioration in the company's prospects. Economic downturns can also lead to broader financial opportunities beyond the stock market. During periods of financial stress, assets such as real estate, private businesses, and other investments may become available at lower valuations. Investors who maintain financial stability and strategic thinking during difficult times often find opportunities that would not exist during periods of economic prosperity. Ultimately, whether a stock market crash represents a risk or an opportunity depends largely on how investors respond. For individuals who panic and sell assets at the height of fear, market crashes can result in significant financial losses. However, for those who remain calm, maintain a long-term perspective, and continue investing strategically, market downturns can create powerful opportunities for wealth creation. The stock market is inherently cyclical, moving through periods of optimism and pessimism. Understanding this pattern allows investors to approach crashes with greater confidence and preparation. By focusing on long-term growth, maintaining diversified portfolios, and continuing to invest during downturns, individuals can transform market volatility from a source of fear into a tool for financial progress. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.